In this video, we are going to be looking at EVgo. If you want your own stock analyzed, throw that in the comments. We'll get round to it when we can. Now, to get straight into it, we can see we're currently sitting around $4.85. We did have earnings recently, and we can kind of see what this move here is what happened off it. So what are those key levels that we're paying attention to, though, from here? So for this, we will use the standard deviation channels. On the left, we have a 6-month chart. On the right, we have the 1-year chart. And then what I'm really paying attention to is, firstly, where did we start to pull back? So we came into our first deviation over on the 6-month. We hit into that, started to pull back. We smashed into the statistical mean between the 6-month and the 1-year, which are basically the same value. There's only about a 5-cent difference. And this is always quite good because when the deviations are close together, just makes them that bit stronger. So what we can see is obviously we're kind of broken through today. So what I'd really be waiting for is probably a retest of this level. But overall, if we hold below that 515, then our target is going to be down to around 360 to around 380, because this is our first deviation between the 6-month and the 1-year. Now, if I was looking to be long bias on EVgo, those would be the levels I'm paying attention to. We would also be catching it near that 52-week low. And if it did break it, then we're also then looking at 250 and 190 as lower down supports. But on a stock like this, where you can see on the 6-month it's downtrending, on the 1-year a noticeable downtrend, this is really a stock I would much rather catch short bias. So if we start to pop, I'm looking at 650 and 680. These are our first deviations between the 6-month and the 1-year. So this is the first zone of resistance where I'd really be looking at it a bit more short bias. But rare, I'd really be looking at the main shorts, and on a lot of these smaller cap stocks, I prefer to get them at the 2nd or 3rd deviations, just because, again, it's just going to make it much more likely that your trade succeeds. But then also the money you make on that trade is usually a lot greater, because usually if you're getting in at the 650, again, you're usually having things with defined risk, so you can usually average into those trades as they push up. So looking at kind of a 775 and an 850, 910 and $10, these would be the key resistances I'd be paying attention to if we broke this 650 to 680, which, again, on a stock like this, it is a volatile stock. That can definitely happen. And that's why I may, if I did trade the kind of 650 to 680, I'd probably use quite small size and really wait for the proper trades coming into these higher up deviations, just because, again, there's so much of a better risk to reward on these. Now, EVgo. Again, we said we'd be looking at it short bias. It does have options. Now, this can be great. Then they don't have massive volume, but what it does mean is there is at least enough volume to define your risk. So if I was trading it short bias, there's 2 ways I would tend to trade that, or actually kind of 3 ways. So first, you can just short the outright shares, but again, trading those overnight naked is just really a recipe for disaster. So what we can do is we can buy some calls. You can define that risk for the amount of shares that you're shorting. Then another solution is just buying outright puts. On this, that doesn't always work, and you've got to see how much the premiums are really pricing in, because a lot of times it can be very expensive to short through the options. So sometimes it can go your direction, but you may not make money. So again, look into that if you're trading outright puts. And then the third way is through a credit or debit spread, which may be difficult because there's not a ton of volume on here. But again, that's basically just saying in about 2 months or whatever time frame you pick, you could say, for example, in 93 days, we're going to be below, say, $7 or $7. And again, if we stayed, right now we're at $5, so you could say if you're going to be below $5, then it's usually a 1-to-1 risk to reward. So that would be the third way I'd be looking to do it, and that's usually how I trade the bigger ones like the GME, the Bed Bath & Beyond, the AMC. When I'm trading those, I only trade them short bias, and I traded them through credit or debit spreads. But again, those options were a lot more liquid, so that may not be the best option for EVgo. Anyway, those are the key levels we're paying attention to. Those are also ways that if I was trading it, those are probably the 3 options I would be picking from. And if you did enjoy the video, why not drop a like and subscribe if you want your own stock analyzed. Again, throw that in the comments. And if you enjoyed the video, why not check out this analysis video.